Welcome to the LSR Weekly View. The US economy is firing ahead on all four cylinders before Mr. Trump takes any measures. This week's information has simply redoubled that story. If we look at what was weak in the springtime, which caused quite a lot of pessimism about the US economy, the main things were that exports had been weak for most of the previous year, business capital spending had been weak, inventories had been weak, and even housing dipped down a little bit in the second quarter. But of course the consumer was very strong, and so in spite of everything there was growth of 1.25%, which actually is only just below the potential growth rate of the US, which is 1.5%. So what's happened since? Well, exports rebounded furiously in the third quarter. That's unlikely to proceed at anything like the same rate in future, but nevertheless it's positive rather than negative. Business capital spending, as we saw this week with relatively strong durable goods orders, is on the up. It's not strong, but it's no longer declining, and of course it's heavily helped by the recovery of shale fracking, which was at its low point in the spring after the low point of oil prices a little bit earlier. And lastly, on the inventory front, there has been a rebound into minor inventory accumulation from actual liquidation prior to that, and that again contributes positively to GDP. Possibly more importantly, I would say, we have a little bit of a housing rebound, which is always good to see. Potentially, relative to the population, the rate of house building has fallen far below the previous levels that was prevalent in the second half of the 20th century. And in fact, over the last 10 years since the housing crisis struck, which was actually in the middle of 2006, you've had a shortfall of houses relative to what would normally be built to accommodate the extra population, of getting on for 5 years worth of building at the current rate of about 1.25 million a year. So the house price upswing looks strong and should continue. And the conclusion of all of this is that the economy was already moving ahead, and will be given an extra kicker in the second half of next year by Trump fiscal stimulus, which means that our forecast on the bond market being in strongly negative territory as far as the eye can see remains in place.